Hello everyone, and welcome to Financial Accounting. In this video, we're going to be going over Chapter 4, which is about completing the accounting cycle. So basically, with this chapter, we're covering everything we need to know about accounting. So you might be guessing, what are we going to be covering in the remaining chapters? It's just going to be more details. So we're going to be going over more details of different account classifications that we have. So in this chapter, we want to start by trying to understand the relationship between the financial statements. So one of those things that we normally don't cover too much in class is a spreadsheet, or what we call it the end of period spreadsheet. But we're going to see like how this, if we're using the spreadsheet, how we're going to prepare the financial statements in what steps. So typically, accountants would prepare this kind of spreadsheet, like an Excel sheet, that would have all the accounts. As you can see here, we have all the accounts where we have the assets, we have the liabilities, and we have the equity on the top part here, which we call them the balance sheet accounts, and we have dividends. And then we have the income statement accounts where we have the revenues and expenses. And you see here in the first two columns, we have the unadjusted trial balance, and then we made the adjustments in Chapter 3, and then we have the adjusted trial balance. And this is where we stopped. Of course, we don't do this using the spreadsheet, or at least we didn't do that using the spreadsheet. But if you want to do it, this is something you can normally do. So once we have a spreadsheet, there's a sequence that we have to follow in order to prepare the financial statements. And the sequence goes as follows. The first thing that we have to start with is preparing the income statement, which is this statement here. You can see this is where we have the revenues and expenses. And we do the income statement to reach the bottom line number, which we call it the net income. If it's a negative number, we call it net loss. So the purpose of the income statement is just to show how much profit or loss we made for a year. And it's called, again, the income statement. So I just want to remind you that we have to write the name of the company, we have to write the name of the statement, which is the income statement, and then we write, in this case, it's covering 2 months. So for the 2 months ended December 31st, 2017. Once we have the income statement ready, we use this net income number to prepare the retained earnings statement. So this is the statement that comes next. So we start with retained earnings beginning balance, which in this case, since the company is just started, they don't have any balance, so it's 0. And then we add to it the net income, subtract the dividends, and that will give us the amount of change in retained earnings that we add to the beginning balance to get the ending balance retained earnings. So technically, the statement of retained earnings or retained earnings statement is a statement that has 4 lines. Beginning balance plus net income minus dividends to get the ending balance of retained earnings. And we cannot prepare this statement of retained earnings without having the net income value, because it's one of those lines here that you can see. So that's why we have to start with the income statement. Once we have it ready and we got the net income, we can prepare the retained earnings statement, or sometimes I like to call it statement of retained earnings. Once the statement of retained earnings is prepared, then the final stage is preparing the balance sheet. And the balance sheet only focuses on accounting equation elements, which are assets, liabilities, and equity. So you see here we have the assets, we have the liabilities, and then we have the equity. Part of the equity, or stockholders' equity, is a line for retained earnings. And this comes from the ending balance of retained earnings. You see here it's December 31st, 2017. That's our ending balance. So there's no way we can prepare the balance sheet unless we have retained earnings statement ready. So please remember this. This is one of those questions that you might see in exams. What is the sequence of financial statements preparation? So we start with the income statement, retained earnings statement, and then finally the balance sheet. So the end of period spreadsheet on the previous slide begins with the unadjusted trial balance. The unadjusted trial balance verifies the total of the debit balance equals the total of the credit balance. And this is based on what we had in Chapter 2. If the trial balance totals are unequal, an error has occurred. And in this case, any errors must be found and corrected before the end of period process can continue. So once the debit and credit are not equal, we have to stop. We cannot continue. And we need to fix these errors before we continue. The adjustments are normally entered in the order in which the data are assembled. If the titles of the accounts to be adjusted do not appear in the unadjusted trial balance, the accounts are inserted in the proper order in the account title column. And remember, we started with the balance sheet accounts, we have the dividends, and then we have the income statement accounts. So whatever the account that we added because of the adjustments, we just put it in the correct category. The total of the adjustments columns verifies that the total debits equal the total credits for the adjusting entries. The total of the debit column must equal the total of the credit column. So once we're done with that, the next step is the adjustments in the spreadsheet are added to or subtracted from the amounts in the adjusted trial balance columns to arrive at the amounts inserted in the adjusted trial balance column, which is the last two columns in the spreadsheet that we've seen. The totals of the adjusted trial balance columns verify that the totals of the debit and credit balances are equal after adjustments. So as we've seen in slide number 3, which was like 2 slides before this one, the accounts from the adjusted trial balance flow in the financial statement as follows. The revenues and expense accounts, they flow into the income statement. The dividend account and net income account flow into the retained earnings statement. And then finally, the asset, liability, and common stock accounts and the end of the period retained earnings amount flow into the balance sheet. So again, one more time, the sequence of the financial statements would be as follows. We start with the income statement, then the statement of retained earnings or retained earnings statements, and then finally the balance sheet. We use the net income number in the preparation of retained earnings statement where we have a line for net income. And we use the retained earnings ending balance in part of the stockholders equity where it says retained earnings. So that's why we need this kind of sequence. So please make sure that you know this sequence because again, it's an exam question. You might expect to see something like that. Now let's talk a little bit more about these statements in more details. So let's start with the income statement. What is an income statement? So the income statement is prepared directly from the adjusted trial balance columns of the end of period spreadsheet beginning with fees earned. And by the way, fees earned is a revenue account. And I want to remind you that fees earned, it's a revenue account and it has a credit nature. The expenses on the other side in the income statement are listed in order of size beginning with the larger items. Miscellaneous expenses is the last item regardless of its amount. So whatever the value is, it's going to be the last in the list because it's miscellaneous. And one thing you'll notice is in most cases, it's also the smallest value. Now let's see the retained earnings. In the retained earnings, the first item normally presented on the retained earnings statement is the balance of the retained earnings account at the beginning of the period. If this is a first year business, like in other words, this is a business that just started, the beginning balance would have a value of 0. The amount of dividends is then deducted from the net income to determine the ending retained earnings account balance. Then the last statement that we're going to talk about is the balance sheet. The balance sheet is prepared directly from the adjusted trial balance column of the end of the period spreadsheet, beginning with cash. So we always, in every single balance sheet, we always see the first account listed is cash. So it has to be cash. The assets and liability amounts are taken from the spreadsheet. The retained earnings amount is taken from the retained earnings statement. So please remember that because the retained earnings amount presented on the balance sheet is typically coming from the statement of retained earnings as its ending balance. A balance sheet that shows subsections for assets and liabilities is called a classified balance sheet. So assets are commonly divided into 2 sections. One is called the current assets and the other one is called property, plant, and equipment. Liabilities are also commonly divided into 2 sections. One is called current liabilities and the other one is called long-term liabilities. So let's talk a little bit more about current assets and property, plant, equipment, current liabilities, and long-term liabilities. So we start with the current assets. So what are the current assets? These are cash or other assets that are expected to be converted to cash or sold or used up, usually within 1 year or less. So the normal operations of the business, and these, we typically call them current assets. I want you to remember, current assets, they always start with cash, okay? And there are also these other assets that we expect to be converted to cash, sold, or used within a period, and this is very critical, 1 year or less. Okay, so that's the most important thing about current assets. The cutoff line is 1 year. If it's something that's going to stay in the business for a period longer than a year, it cannot be classified as current assets. So what are some examples? Cash, accounts receivable, notes receivable, supplies, any kind of prepaid expenses. All of these are examples of assets or other assets, cash or other assets that are expected to be converted to cash or sold or used within 1 year. So what are the notes receivable? Because we talked about accounts receivable before. What are the notes receivable? Notes receivable, they're very similar to accounts receivable. The only difference is that they're not verbal agreement. These are written agreements. So notes receivable are written promises by the customer to pay the amount of the note and interest. Like accounts receivable, notes receivable are amounts that customers owe, but they are more formal than accounts receivable. Notes receivable and accounts receivable are current assets because they're usually converted to cash within 1 year or less. How about property, plant, and equipment? Property, plant, and equipment, sometimes we refer to them as fixed assets, plant assets, and by the way, we'll spend one chapter talking about these. They include land and assets that depreciate over a period of time. By the way, land does not appreciate. But all other property, plant, and equipment, except for land, they depreciate. And we'll talk about what we mean by depreciate, which is basically they lose value over time. So assets that depreciate over time include equipment, machinery, and buildings. How about current liabilities now? Current liabilities, these are the amounts the business owed to creditors that would be due within a short time, usually 1 year or less, and that are to be paid out of the current asset. Current liabilities include notes payable, accounts payable, wages payable, interest payable, taxes payable, and unearned fees. So you can see that anything that has the word payable in it would be a current liability, with the exception of unearned fees, which is unearned revenue. So unearned revenue is one of those exceptions. How about long-term liabilities? These are amounts the business owed to creditors that would not be due for a long time, usually more than 1 year, and that's why we call them long-term. So again, the cutoff period is 1 year. If we have an obligation that has to be paid within a period less than a year, we classify it as current liabilities. If it's longer than a year, we call it long-term liabilities. And then finally, we have the stockholders' equity. So stockholders' equity is the stockholders' right to the assets of the business. It's presented on the balance sheet below the liabilities section. Stockholders' equity is added to the total liability, and this total must equal to the total assets. And this is a simple application of the accounting equation. Remember, we have assets equal liabilities plus equity. So the value of stockholders' equity, when we add it to total liabilities, it should match the total assets. So let me stop here, and then we'll continue in the next video.